Welcome to the latest episode of Gowling WLG's Listener Podcast, where we look at a range of topics trending in the legal and commercial landscapes.
Hello and welcome to the first episode of the Gowling WLG Build to Rent podcast. I'm Nick Mumby, a partner in the real estate group and lead partner for our BTR subsector. Today I'm joined by Andrew Screen, the head of residential capital markets at BNP Paribas Real Estate. We're going to be taking a look back at what happened in the markets in 2022 and try and make some predictions for the coming year of 2023. Andrew, great to have you with us. I can't think of a better person to pick through some of the issues and some of the investment topics that we're going to be covering today.
Nick, delighted to join you this morning.
So let's start with 2022. It was a fairly tumultuous year for many reasons, both with macroeconomic and political instability and all sorts of other things causing a hard time for the markets. But with all that going on, BTR held up pretty well, and for at least most of the year, it was both a successful investment product and there was quite a lot of activity.
Yep, so 2022 started off, we had obviously construction cost increases that had come out of 2021, but those were sort of very much on everybody else's mind, as well as our contractors and developers and investors. We also had increase in interest rates going forward, which obviously made everybody very much concerned, particularly with funding development costs. But again, investment was still very strong. We saw new investment coming in about June, July, through to about August, September. And these are new entrants into the market with lower cost of capital. So basically cheaper money to invest in the sector, and obviously interested in the sector purely from its growth in the past. We then went into the mini budget, which was, at that stage, we went into literally the shutters came down on investment, or what I like to call a financial state of suspended animation. The money was there, but it wasn't moving.
Yeah.
And that was certainly into the kind of the last quarter. But what's great is we have seen the money coming back in the last month, in January. And these are investors who are certainly looking at investment. They want to see all types of investment, both larger investments. So those are the normal standard 350 units plus on build to rent. But what's quite interesting is investors looking at those 100 to 250 units as well.
Yeah, very good. And we'll come back to that a little bit later on. And in terms of locations and, again, sort of sizes of schemes throughout 2022, I think it's fair to say it was focused on the main markets, the main cities. But what were your views on that and where people were looking to invest primarily?
This is quite interesting because the majority of investors target London and then the key regional cities for their investment. But actually, when you have a look at build to rent, 60% of all the investment has gone into the regional cities and locations, and only 40% into London. So yeah, you get better returns being on the regional side rather than London. Also, there's a lot more supply, probably less planning regulation, easier to get planning in the regions. In other words, there's more transaction availability in the regions than in central London. But we expect to see the kind of key regional cities continue to grow in build to rent. So that's Manchester, Birmingham, Leeds, and Bristol. Those are what I call super prime.
Yep.
In other words, they attract some more attention than the kind of, if you want, the other secondary kind of regional cities.
And is that driven by a sort of a growth in market knowledge, and as the market matures, from investors who are then more prepared and more sort of comfortable putting their money into the regions outside London? Or is it more that there's a larger amount of local UK investment, and therefore, we already have a good knowledge of those regional markets?
The answer is yes to both.
Okay.
So what we have is that the majority of international investors prefer the first asset to be in London. That's kind of the safe haven. Everybody wants that first risk effectively to be in the lowest risk capital, which is London. And then they will move out to Manchester, Birmingham, Leeds. But you're quite right. In terms of most of the regional, in other words, secondary and tertiary locations, most of those are UK pension funds, driven by those, or people who invest in basically secondary or tertiary product primarily. But generally speaking, out of all the investment, you've got 75% of the investment will go for London, Birmingham, Manchester, Leeds, those super primes. And then you whittle it down to 50% or 25% of investors will look at then those secondary or tertiary locations.
Yeah, understood. That all makes very good sense. And so looking forward, 2023, you said there's a bit of activity already, but I think we'll probably both agree that it's not exactly going at full speed at the moment. And how do you see the year coming forward? What are we to expect this year, do you think?
I think it's going to be a very exciting year in terms of phases. So it's important to understand that a build-to-rent transaction takes about 6 to 9 months to complete. In other words, that's from the developer putting the product into the market to actually closing a deal, and depending on the kind of debt funding and whatever used. So in other words, to get to financial close, it will take about 6 to 9 months.
Yeah.
Which means that any transaction that was basically started last year will only come forward kind of this year. And that's why if we had a sort of dry last quarter, in other words, the investment not moving, it means that those investors are not looking to tie into deals in terms of heads of terms and getting into legals. Now, when you kind of look forward, it means that any deal that comes to market in this quarter will probably only close in Q3, Q4.
Yeah.
So the deals that we're actually closing in Q1, in terms of January and February, those are deals that went back into that June-July period.
Yeah,
so
that makes sense.
So these are development deals, not stabilized assets, which obviously trade a lot faster. So in terms of actually the 4 quarters of the year, I expect this first quarter we're going to see a lot of investors looking for product. Everybody wants to get a deal and to certainly close a deal by the end of the year. That's where the pressure is going to be on, to close a deal within that kind of 18 months since last year, June, July. And to do that, everybody needs to be finding their deal and settling into their deal now. I think Q2 will be driven by heads of terms.
Mm-hmm.
So those deals will be identified, certainly going into heads of terms, looking at how they can structure the deal best to their advantage, and then instructing legals in that kind of Q2, Q3 point. In other words, that then leaves you into Q3 financial close or Q4 financial close. And some of those may stretch into Q1 of next year.
Okay, super. So I'll be taking my holiday over the next few months and getting ready for a busy second half of the year, hopefully.
That's certainly the way I would say it. But we're going to see an influx of deals coming in, particularly in Q2, because a lot of deals were held up or held back by developers because of the lack of investment in Q4. These are all going to start coming through. So we're going to see a flurry of deals, certainly in that Q2.
Which is good, and also suggests that there's some money coming from potentially different places. I.e., if the investment wasn't there at the end of last year, things have settled down a bit. Are we seeing some new players coming into the market, or is this just some of the existing players who've tooled up particularly well and are have got piles of cash to deploy?
We've got a huge supply-demand differential in this market. In other words, a massive demand for rentals, both as for sale accommodation and very little supply coming forward, as well as investors that are targeting the sector. So in last year, kind of June, July, we saw a lot of funds reallocating funding to the living sectors as opposed to kind of build-to-rent generally. Yeah, but to that living sector. And these were very serious players with a sort of intent of £1 billion investment in these sectors. So this is over and above the existing investors who are obviously trying to expand their portfolios. So this year we're going to see new money coming in. So we've already seen some identified, and certainly coming into the sector at that sort of 200 million to £1 billion. So we're going to see a lot more money, and I think it's going to be quite interesting because we've got very little supply. In other words, very little product in terms of built-to-rent forward funding deals and also sale product.
Yeah, okay. You mentioned forward funding. One of the things that you and I have discussed is that's always been the sort of the model. That's what developers quite like, because they can bring their product to the market and then effectively pass it on to the investor, build it out, and know that if everything goes well, then they get a kicker at the end. But they've also got their fees paid and all the rest of it, and they've shifted the site that they've allocated, so they've got their capital up front. Looks like that might be something which a lot of investors are now sort of a little bit less keen to use that type of structure and are more incentivized to try and keep the developers with a bit of skin in the game. Is that something that you're seeing with sort of some of the deals that are coming through and the structures that are being proposed?
So this is so just to give you a basic idea, there's a typical transaction like forward purchase. So we're going to see a lot of house builders offloading stock on a forward purchase type of deal.
Yep.
Where they can't sell it into the traditional markets. On the forward funding deals, the reason why these structures will change is because there's uncertainty in the market. So there's a lot of money chasing the sector, but the problem is that there's uncertainty about how that's going to come forward. So what's going to happen is that you're going to see those structures changing. My personal view is that the yields will not shift out to the capitalization rates because there's such a demand for the product. But the issue is that a lot of investors don't know that. And so their kind of view is that yields may move out because they've moved out in all the other sectors.
Yeah.
Retail's moved out, industrials have moved out, logistics, they moved out, they come back in again and moved out. So what's going to happen to build to rent? And I think this is the important thing, is that you got high rent growth rates, as well as kind of yields, which I believe will remain stable as they are at the moment. But from an investor's perspective, will those rental increases really happen? And will the yield really stabilize? So in terms of the restructuring of the deals, I think what we're going to see is a risk transfer to some extent.
And that seems sensible, doesn't it? I mean, up to this point, and I say this primarily as a developer's lawyer, so I probably shouldn't say things like that as the, clearly that means the developer taking on a bit more risk. But it's the structure that we've seen in a lot of other types of transactions. A lot of other offices, for example, is often the way that the developer is required to take an equity stake and to build it out and do it through a joint venture type arrangement where they do still have they have some skin in the game, and therefore they are more incentivized to ensure that all the targets are met and so on and so forth, because they don't get anything back until a bit later on.
I think the best thing is probably to describe it with an example. So let's just say the total development value is 100 million, and that includes the developer's profit of 10 million, 10%, and includes the land value of, let's just call it 10 million as well. The uncertainty we have is that, will it be worth 100 million in 2 or 3 years' time? Will that rent growth happen outside of what the normal performance is? In other words, what the investor's looking to do is say, well, if it doesn't happen, then I don't want to be paying out all that profit payment, or I don't want to be paying out all the land payment. So we are going to see deals whereby either a portion of that land payment is deferred to the back end, PC, or to stabilization, and likewise that profit payment. In other words, once that asset's built out, it'll have a value, but once it's leased up, it'll have a certain value.
Yes.
And once that certain value can be determined, and from my point of view, is most developers, I'm very pro the industry and certainly pro build-to-rent growth and what have you. I think those growth rates will happen. I don't think yields will move out. And because of that, I speak to developers and say you should take confidence that that product will retain that value. Because generally speaking, investors are very cautious and they will be taking a lower view on values and kind of risk as well. So I don't see it. I just expect to see those kind of structures coming forward. We've certainly spoken to investors who are looking to do a deal, as they put it, which can also relate to not only deferring of land payments and profit payments, but possibly also where there's a preferential return for the investor before profits paid out. All of those structures are effectively the same thing. In other words, deferring that risk. But I think what's important is that the developer should understand that they should be entitled to an upside.
Yeah, of course.
On those returns, because they're effectively deferring the profit, which in their view, they shouldn't be deferring that profit.
And so to that end, there is a potential for making, if prices and yields remain, at the right levels, we're going to have more profit, which means there'll be more money for everybody, and the developer will get a share in a bit of that as well.
I think we've got two kind of worlds that we're living at the moment. You've got huge news headlines, house prices are falling, going to fall during this year, which I agree they will. Not by a huge amount, and I think they'll bounce back fairly quickly. But you've also got rents going up, as well as capitalization rates not moving up. So that means that actually, if on a rental product, your value is going to increase. Whereas on a sale product, you're seeing a decrease.
Yeah.
And surprisingly, you've now got this gap in the market, and it's clear, convince an investor that this gap is there.
Yes.
It does actually exist, but the for sale prices will come back.
Yeah, of course.
So I think this is the slight problem, is everybody's going, well, the built to rent must then be falling in price, and that's not the case.
No, indeed. So, indeed. And you mentioned that rents are increasing, and they are at the moment, and don't want to get down too much of a rabbit hole, but rent caps are something that do come up in conversation. And what might be just some of the sort of high-level impacts of if we did see rent caps being imposed either nationally or in or over specific markets like London?
I think there's a lot of talk about affordability. We've got a huge demand for rented product, very little supply of rented product, which means rents are going up. They went up 12% last year. London up 17%.
Yeah.
And so there's obviously a lot of people concerned about rent increases. I firmly believe that if you want to reduce rentals or control rentals, you should increase supply. Let's go back to basic economics, supply and demand. So build more homes of all types, and basically rents will not go up as quickly. And so that's quite simple. But I think the issue is that this is seen as a kind of an immediate stopgap position. In other words, if we put a rent cap on, that'll be fine. It'll become more affordable for everybody. And I think it's a short-term kind of provision, because you still don't address the underlying problem, which is the lack of supply.
Yeah.
Which comes back to planning, comes back to regulations, and that's why you get this supply-demand indifference, which you don't normally see in like the US, for instance, where the planning is much more efficient. But in terms of rent caps, is that one of the fundamental problems that I have with rent cap is that it's because it's not consistent. If you're an investor underwriting a return, you want to know that that return, or effectively your rent increases, are linked to some kind of CPI index or RPI index or HPI index for that matter. But if you've got a local authority or government that can suddenly just turn around and say, your rent cap was 4%, but now it's 2%, or that it's capped at a level, or basically that you now removed it or brought it back in, it's that inconsistency which is difficult to underwrite from an investment perspective.
Of course. So we've been talking about new structures. We've been talking about various different ways in which the pricing, construction pricing, investment returns impact on the product. We've also seen already quite a lot of regulatory changes. There are more regulatory changes coming down the line. Some of them we know about, some of them we don't. We touched on rent caps just a minute ago, which is something that people might start to look at, and some interesting thoughts from Andrew on what the impact of that might be. But we've also got some changes along the lines of EPCs with more stringent requirements coming in. And what do you think the impact of that is going to be first up?
I think on EPC, we've already seen something like 300,000 built to buy-to-let landlords move out of the sector in the last 5 years. And this is largely down to taxation, but also, regulation as well. So
the individual is being squeezed out.
Exactly. And so as that EPC starts to bite, which will be kind of 2025 and 2028, particularly 2028, which is the effect of the drop dead deadline. So 2025 is for all new build property.
Yeah.
2028 is for any property on the route to rental. Now, will all of these, will we see a mass exodus of landlords in the space? Well, the way the legislation is written, yes, we will. But whether it's actually practical to implement that, I'm not quite sure.
Yeah.
But what it really means, as you put it, are those sort of buy-to-let landlords being squeezed out? And certainly they are. Does this mean we're going to get more institutional funding coming into that space? I think we'll certainly get new product.
Yeah.
Because that's the only way to basically satisfy the EPC and a lot of the other regulations, like number of staircases, fire regulations that have come into the sector as well.
Yeah.
So institutional investment coming into the sector, that's a good thing.
Yes.
But the reduction of overall rental supply or stock is a bad thing.
Of course.
Because obviously if you take out rental stock, prices go up again. You get less supply into the market.
Exactly. And it's one of these things that it's difficult for institutions to buy individual or even small portfolios, because for the product to work, they need numbers, they need to aggregate, and obviously dealing with it in a very granular way is very complicated and not something that they've really been able to achieve. On the difference between institutional landlords and private landlords, there's often a lot of discussion about the good points and the bad points. But actually, it does seem that on the whole, an institutional landlord is going to be much better for the renter than a private landlord. I think that's a fair assessment. Would you agree, or is that giving too much credence to the advantage of our big pension funds?
I think it goes down to two things. One, economies of scale.
Yeah.
In other words, the institutional landlord can get more properties, therefore more efficiently manage those properties for a cost base. In other words, the gross to net or operational costs. Also, they can build out bigger schemes compared to the smaller kind of buy-to-let kind of landlord. The interesting thing is, though, that I think we need all types of product, because the institutional landlord will not go and invest at scale in a lot of locations. Particularly, for example, Cornwall, where there's still a demand for rented accommodation, but doesn't necessarily attract institutional landlords, mainly because we come back to scale again. And I think what's quite interesting, what's happening in the market, is some of those institutional landlords are now looking at smaller scale kind of build-to-rent or PRS blocks.
Yeah.
That 100 to 200 kind of units as opposed to being 350 units plus. So across the whole spectrum, I think we need to encourage landlords as much as possible. But evidently, most residents will prefer a fully amenitized unit.
Yeah.
If they can get it.
But of course, as you say, for those smaller schemes, the amenities, it doesn't support the same level of, or doesn't support the need for the same level of amenities. You can't get the space to be able to provide more than perhaps, a gym or a few communal areas. Okay, and then just looking wider at the increase in investment into single-family housing and how that is sort of coming together within the market as a sort of as a separate BTR or distinct BTR product. Where do you see that coming forward over the next year, and how do you see that coming forward over the next year? And what are the advantages? What are some of the advantages to investing into that type of product?
Well, we saw a couple of portfolios trade in the last few years in single family. But one of the biggest problems about institutional investment into single family is being able to aggregate. In other words, being able to get to scale.
Yeah.
Because if you're buying 10 units at a time, it's very difficult to transact £500 million worth of stock.
Of course.
So that's why the single family housing investors have typically been targeting 50 units or 100, 150 units. What's quite interesting is we're going to see house builders offloading stock where they can't sell into the normal for sale market, looking at those institutional buyers. So this is an opportunity for institutional investors to get into that single family housing, or rural housing for a better word, at scale. So I think you're going to see that institutional investment grow into that sector over the next 2 years.
Yeah.
As they can get to scale a lot more quickly.
Absolutely. And of course, it's been precipitated by things like interest rate hikes, which has made mortgages more difficult to get, which have meant that the individual has found it more difficult to buy. Of course, Help to Buy coming to an end as well, another one of the sort of big products that has been of great advantage to the house builders and to purchasers, of course. But it does seem that has created an opening for institutional investors to come and talk to the house builders and say, actually, don't sell this whole section to individuals. We'll buy that. And of course, once you're into that type of cycle, the house builders realise that it's a more efficient way. It might not necessarily be as profitable as it is by selling them on an individual basis, but they're getting the cash in on a much more efficient basis.
Single family is quite interesting because if you invest in, let's say, build to rent, you're investing 150, 200 million in one building. Yep. Which means you've got a 3 to 4 year construction period. So you're at a risk from the development phase for 3 or 4 years. In single family housing, don't forget these houses are built over a period of months.
Yes.
So you can have, and at any point in the cycle, you could just stop the construction and not build that anymore or not invest in anymore. So you're also getting a lot more units completed and stabilized on a phased basis. So you're getting income in during actually your overall construction period. So that's the advantage. They're a lot easier to manage because you're not actually providing all of those amenities. There's some schools of thought that single family housing should come with amenity levels. Other schools of thought that basically that they are not, they're purely just a landlord, if you're one resident relationship.
Yeah.
But either way, yeah, it is a slightly different product from your built to rent.
Of course.
But it is more akin to rural accommodation, which built to rent doesn't really work for.
No, precisely. And just going back to our investors again and just thinking about what they're looking for, where are we in terms of returns and numbers and the such like? What are you seeing at the moment in terms of the expectations of investors coming in and looking for product?
Well, we've had, in the past, the target kind of returns from most investors in built to rent was kind of a 16 to 18 percent IRR over roughly at about a 5 to 7 year hold period. And that was on a levered basis of about 65% debt funding. Now, obviously with the increase in debt funding costs, which have almost doubled, so in other words, your total kind of debt funding costs for construction roughly works out at about 11%. By the time you take in the debt funding, the hedging costs, the arrangement fees, all the other fees in.
I'm going to say if you can get the funding in the first place.
Yeah. So, and because of construction cost increases and interest rate rises, you can't get to a 16 to 18% IRR on it.
No.
What's interesting is most of the new money coming in is at about a 10 to 12% IRR. Or shall I say that's the new expectation, certainly from a developer's point of view. And so that lower cost of funding, if you're at a 10 or 11% IRR on equity, pure equity investment, that doesn't make any difference whether it's unlevered or levered.
Yeah,
because
okay.
the debt costs you the same. In other words, debt's no longer accretive
Yes.
to those type of developments. So a lot of interesting points coming forward here is that, we're going to see quite a lot of investors just funding 100% equity, no debt finance during construction, and then they'll refinance out later once rates have been improved.
Yeah.
Or their hedging costs aren't so expensive.
Exactly. And once you've got a stabilised product that you can take to a funder and who can analyse it a lot more clearly, I think this is one of the issues that I've seen with a number of putative loans is not being able to get a fixed and get a proper feel as to the exact construction costs. If you can't get a feel for the construction costs, you don't know what your overall input is, and that causes huge problems from an underwriting perspective. It's maybe not quite that bad all the time, but if you're a conservative lender, then you're going to struggle to get comfortable with the position at the moment.
One of the interesting things about it is that you've got, because of the rent increases in built to rent, and rents will go up 5 to 7% this year, again and possibly again next year. It means you've got a play on both the capital asset value, so there's your yield, and plus your rent increases, giving you a total return, which isn't something you see frequently in other asset classes.
Yeah.
So this is an opportunity, but it's a case of investors being cautious to underwrite a more sensible rent inflation versus what will probably actually be achieved. Yeah, so it's a very interesting play at the moment from an investment point of view across the whole of the living sectors, not just built to rent.
Yeah, no, understood. Okay, so I think it sounds like we're going to see an interesting year. It sounds like it is going to be busier towards the end of the year. We're hopefully going to get all of those heads of terms in circulation over the next 3 to 4 months, maybe, with as you say, with the deals coming forward Q3, Q4, and I think it is, and it certainly sounds like it should be a good bet for investment in terms of returns and everything else. It's just whether or not there's enough product on the market to satisfy everybody's appetites. Andrew, anything further from you? Anything we haven't covered that you'd like to say right now?
Sure. It's going to be interesting to see the types of transactions we're going to be seeing this year as well. I think we're going to see a lot of purchase of block, in other words, PRS blocks, 50 units, 100 units, going up to what some people are terming built to rent at 150 units. We're going to see that whole spectrum of the smaller scale as investors look to get into the market. So that's either stabilized product or to be built product. We're also going to see the standard 400-500 units kind of product coming forward as well, as we have seen in the past. But I think this year we are going to see mergers, acquisitions coming forward as well. So there'll be a couple of corporate transactions, and this is because we're seeing a lot of those players who are interested in investing 500 million into the sector fairly quickly. So I think it'll be the first year we see those big transactions coming forward, and certainly that'll probably continue over this year and next as that huge amount of equity gets to come into the sector and play at the larger scale.
Something very exciting and something to look forward to.
It most certainly will be.
Andrew, thank you very much indeed for your time.
Thank you very much, Nick. It's been a pleasure.
Thanks for joining Gowling WLG for this podcast. If you enjoyed this episode, be sure to check out our website at gowlingwlg.com for more useful insights and resources. And don't forget to subscribe to ensure you join us for our next episode.